Have you ever stopped to think about what actually controls the world? I don't mean politicians, and I don't mean armies. I mean the invisible forces, the hidden gears that dictate the price of absolutely everything around you. The cost of the gas in your car, the price of the coffee you bought this morning, the value of the money sitting in your bank account right now. For decades, we were all basically clueless. We went to work, we paid our bills, we took vacations, and we just assumed the global economy was this massive, natural force, kind of like the weather or the ocean, uncontrollable, unpredictable, and completely untouchable by any single human being. But what if I told you that wasn't true? What if the ocean wasn't moving on its own? Imagine a heist, but totally wipe the bank vaults, the getaway cars, and the ski masks completely out of your mind. There are no alarms blaring in the middle of the night. There are no shattered glass doors, no dramatic police chases. Instead, I want you to picture a brightly lit room, incredibly quiet, high up in a glass skyscraper in London or New York. Inside, men in extremely sharp, expensive suits sit behind walls of glowing computer screens. They type quietly, they casually sip their lattes. To the outside world, to their families, to you and me, they are the smartest guys in the room. They are the highly respectable bankers keeping the engine of the global economy turning. But in reality, what they are doing right from those keyboards is pulling off one of the largest, most invisible, most mind-boggling robberies in human history. And the craziest part? For years, nobody knew. It was a complete mystery. The world just kept spinning. Your pension kept getting managed, international trade kept moving across oceans, everyone was completely in the dark, entirely clueless that a tiny, hidden group of rogue individuals had effectively captured the control room of the global financial system. They literally held the keys to the kingdom. So, welcome to this explainer. Today, we are slowly pulling back the curtain on a massive financial thriller that actually happened. We are going to look at the sheer scale of the manipulation, how they did it, and the shocking aftermath that left the financial world reeling.
Okay, so to truly understand the sheer gravity of this story, we have to start with the numbers. And the number you need to focus on is $5.3 trillion. I know, a number like that is almost impossible to wrap your head around. It sounds fake, right? But listen to me carefully. That is not a yearly figure. That is not the total GDP of an entire country over a decade. That $5.3 trillion was the daily volume of the global foreign exchange market back in 2013. Every single day, $5.3 trillion changing hands. That is enough to make the stock market look like a lemonade stand. It is the absolute, undisputed, biggest market in the world. It's the blood flow of the entire global economy. Think about it. If a massive tech company in the US buys millions of microchips from Japan, they have to use this market. If you travel to Europe for summer vacation and buy a croissant, you use this market. The stakes here are massive, they're almost incomprehensible. And yet, here is the absolute wildest part. For a market this enormous, it was largely unregulated. I'm serious. Regulators and financial watchdogs used to honestly think it was just too big to be manipulated. They thought no single person, or even a group of people, could ever have enough money or power to move an ocean that deep. They figured the market would just naturally correct itself. Well, as you're about to see, they were incredibly, historically wrong.
So the absolutely crucial point here is understanding who exactly figured out how to move this $5 trillion ocean. Listen to this quote. Mess this up and sleep with one eye open at night. Now you hear that and you probably think it's a line straight out of a Hollywood mob movie, right? Maybe someone threatening a guy in a dark alley. But no, this is an actual, real, documented message sent in a private electronic chat room between top-tier, incredibly highly paid bank traders. One of them was literally warning a new trader who they were slowly letting into their secret exclusive group. I want you to immediately contrast the incredibly polished suit and tie Ivy League facade of these megabanks with the totally ruthless Mafia-style reality of what was actually happening behind closed doors. These guys weren't just trading money. They were playing a highly coordinated game, and the rules of that game were shockingly simple. You protect the group, you crush absolutely everyone else, and you make as much free money as humanly possible no matter who gets hurt.
So here is our roadmap for today as we break this all down. First, we'll dive deeper into the $5 trillion market. Second, we'll go inside the cartel. Third, we'll look at exactly how they were rigging the fix. And finally, we'll cover the multi-billion-dollar bust. Let's get into it.
Moving right along to Section 1, the $5 trillion market and how currency actually moves the world.
To really grasp how a few guys pulled this off, you first need to understand the crazy environment these traders operated in. The foreign exchange spot market, which is basically where currencies are traded right now on the spot, is a totally decentralized beast. It literally never sleeps. It operates 24 hours a day, constantly rolling across different time zones. When traders in Sydney are logging off, Tokyo is trading. When Tokyo finishes, London is in full swing, and then New York takes over. Because it is totally decentralized, there is very little centralized policing.
There's no single exchange building you can walk into. It's all done over the counter, through vast, invisible networks of bank computers talking to each other. But in this giant, constantly swirling ocean of money, there are a few very specific, highly predictable moments where the water basically stands still. And that, my friends, is exactly where the trap was set. Now imagine you are a portfolio manager. You manage a giant pension fund with billions of dollars of retirement money. You need to exchange currencies, but you want a perfectly fair price. You don't want to get ripped off by random second-by-second market swings. So you call up your bank and say, hey, give me whatever the average price is at exactly 4 p.m. in London. This 4 p.m. price is famously called the WM/Reuters fix. To figure out this golden price, the system takes a tiny, incredibly brief 60-second snapshot of all market activity. Specifically, 30 seconds before 4 p.m. and 30 seconds right after. Whatever the median price happens to be during that one single fleeting minute becomes the global benchmark rate for the day. Trillions of dollars in investments rely entirely on this exact 60-second window. It is a massive, incredibly vulnerable bottleneck of global wealth. And our group of rogue traders realized something absolutely incredible. They figured out that if you can manage to artificially push the price up or down during just those specific 60 seconds, you don't need to control the market all day, you just need to control it for 1 minute. And by doing that, you can rig the entire global benchmark to favor your own pockets.
Aside from the 4 p.m. fix, there was another massive vulnerability that these traders exploited: stop-loss orders. Let me explain how this works. Let's say a corporate client buys a massive amount of British pounds. Obviously, the market fluctuates and they're worried about losing money. So they instruct their bank, listen, if the value of the pound unexpectedly drops to a certain specific danger level, sell it all automatically, immediately, so I don't lose any more money. This is meant to be a safety net for the client, a way to sleep soundly at night. But here is the massive, glaring problem. The bank is the one managing that order, which means the bank knows exactly where that secret danger line is hidden. This creates a deeply dangerous, totally twisted incentive. If the traders working at the bank can intentionally, aggressively force the market price down just enough to hit that specific danger level, they deliberately trigger the client's order. The bank then gets to buy that currency dirt cheap from their own client. And then, because the drop was completely artificial, they just sit back and watch the price naturally bounce right back up. They make a massive, instant, risk-free profit. And the client? The client is totally clueless. They just see that the market dipped, their safety net triggered, and they took a loss. They have no idea they were just robbed by the very people supposed to be protecting their money.
Okay, let's turn to Section 2, inside the cartel, and pulling back the veil on their secret chat rooms.
So we know exactly what the targets were: the 60-second fix and the massive client stop-loss orders. But the huge question is, how did they actually pull it off? Because realistically, no single trader, no matter how rich, has enough money to move a $5 trillion market all by themselves. To push the price of the entire global economy, you absolutely need an alliance. You need a coalition. So top competitors from rival banks quietly formed an exclusive, totally underground network. They did this using private electronic chat groups right on their trading terminals. Think of these like highly exclusive secret messaging groups, kind of like a VIP WhatsApp chat, but purely for orchestrating financial market manipulation. And I want you to look at the sheer unadulterated arrogance of the names they actually gave these chat rooms: the Cartel, the Mafia, the Bandits Club, and my personal favorite, one team, one dream. I mean, they weren't even trying to hide what they were doing. These guys were the absolute top-tier, head-spot traders at some of the most powerful and heavily regulated banks on the face of the earth. We're talking about places like Citigroup, JPMorgan, UBS, Barclays, and the Royal Bank of Scotland. By all accounts, these men were supposed to be vicious competitors fighting for their respective clients. Instead, they essentially formed an untouchable elite boys club. They spent their entire days in these private chat rooms, joking around, talking in strange codes, intentionally using terrible spelling to avoid tripping the bank's automated compliance security scanners, and casually sharing the deepest, most highly confidential financial secrets of their clients with their supposed rivals.
Let's actually look closely at a real message to see just how deep this twisted loyalty really went. Read this specific message, which was sent by a top Citigroup trader when the group was debating whether or not to let a new guy into their private chat room. Quote, "Don't want other numpties in market to know. Is he going to protect us like we protect each other against our own branches?" First off, numpty is basically British slang for an absolute idiot. That is exactly how they viewed everyone else in the financial world who wasn't in their little club. You were either in the cartel or you were a numpty. But I really want you to look at the second part of that quote, because it tells you everything you need to know. Protect us like we protect each other against our own branches. That is staggering. These guys actively, openly prioritized this secret, illegal network over the very banks that were paying their massive salaries. They flat out didn't care about their employers. They definitely didn't care about their clients' portfolios. The only thing that mattered, the only thing they protected, was the cartel.
Let's move to Section 3, rigging the fix, the actual step-by-step anatomy of a heist.
So, we know they were talking, but how exactly did they turn chatroom gossip into cold, hard, multi-million-dollar payouts? How did they physically manipulate that tiny, fragile 60-second fix window to basically guarantee massive profits day after day after day? Well, the regulators eventually uncovered their exact step-by-step playbook, and it was brilliant in a deeply evil way. Step 1. About 30 minutes before the 4 p.m. fix, the traders would log into the cartel chat room and essentially dump their cards on the table. They told each other exactly what their massive corporate clients were about to do. They illegally pooled all their highly confidential information. By doing this, they figured out exactly how much total currency their combined group had to either buy or sell. Step 2. Now that they knew what they needed to do, they had to manipulate the market's supply. Let's say the cartel realized they wanted the price to skyrocket. To make that happen, they needed to make sure absolutely nobody else was selling during that minute. So right before the fix, they would secretly call up other random clueless banks and carefully trade away all their own sell orders. They literally called this tactic clearing the decks. They were removing any opposing force. Finally, Step 3. The 60-second window opens. The clock starts ticking. Bam! They execute their massive, newly pulled orders all at once in an absolute frenzy of buying or selling. They called this final strike banging the close. Because they intentionally dumped all this massive volume into one tiny, artificially cleared 60-second window, the sheer overwhelming force of it physically bent the global market price to their exact will.
And the language they used to describe this process? It's honestly fascinating. They spoke to each other like they were generals playing some kind of high-stakes war game. For example, taking out the filth. That was their totally degrading term for getting rid of any opposing trades before the 60-second window. They viewed natural market forces as filth that needed to be cleaned up to make sure their path to profit was totally clear. And then you have this concept of building ammo. This is just wild. Sometimes, to maximize the shock and awe on the market, all the traders in the cartel across different competing banks would secretly transfer all of their massive client orders to just one single guy in the chat room. They effectively handed him all the ammo. Then, the second that 60-second fix window opened, that one designated guy would just absolutely hammer the market. He would blast huge, market-moving trades over and over again in rapid succession to violently jam the fix rate up or down. To the outside world, this created the sudden, terrifying illusion of massive, genuine market demand. And here's the kicker. Because the rest of the cartel knew exactly when this guy was going to fire the ammo, they simply placed their own personal bank trades right before it happened, effortlessly making an absolute fortune off the resulting price swing.
Now, take a really close look at this slide, because you are looking at the literal, undeniable visual evidence of the heist in progress. This specific chart shows the price of the British pound against the US dollar on a given trading day. Look closely right at that 4 p.m. mark on the bottom axis. Do you see that sudden, massive, totally unnatural plunge in the spot rate? It looks like the price just falls off a cliff for absolutely no reason and then quickly recovers. I'm telling you right now, that is not natural market flow. That is not random everyday economics. That right there is the cartel at work. That is the exact moment those traders were banging the close, dumping their built-up ammo, and brutally forcing the rate down. Why? To trigger all those hidden client stop losses we talked about earlier, to steal the currency cheap and lock in millions in profits for themselves in a matter of seconds. And they did this day after day. They literally high-fived each other in the chat rooms. They typed out things like, "Hooray, nice teamwork," and "We do $R." They genuinely believed they were totally invisible, entirely above the law, and absolutely untouchable.
But, which brings us to Section 4, the multi-billion-dollar bust. This is where regulators finally strike back. As you know, in any story where arrogance gets this out of control, the supposedly untouchable guys eventually get touched. For years, there were whispers in the financial world. Things looked weird, charts looked wrong, but regulators were honestly clueless as to how it was actually happening. Then everything changed. A massive 2013 Bloomberg leak suddenly exposed these secret chat rooms to the blinding light of day. The veil dropped. Suddenly, the mystery of the suspiciously moving 4 p.m. benchmark was finally solved, and it brought down a storm. Dozens of regulatory and government agencies from all around the world, the FBI, the US Department of Justice, the UK's Financial Conduct Authority, the Swiss regulators, they all simultaneously descended on the biggest, most powerful banks in the world. And what you see on the screen right now isn't just a rumor or a news article. This excerpt is pulled directly from the actual official US Department of Justice plea agreement. It is right there in permanent black and white federal ink.
The government legally detailed the exact existence of the cartel and the Mafia electronic chat rooms. They formally outlined exactly how these men coordinated the trading of global currency pairs, how they intentionally withheld bids to manipulate their risk positions, and how they quite literally rigged the global economy. The gig was up. The banks couldn't hide behind complex computer algorithms or confusing financial jargon anymore. The chat logs were physical, undeniable proof. All the jokes, the blatant collusion, the rampant greed, it was all permanently recorded.
As a result, the sheer scale of the regulatory hammer that came crashing down was absolutely staggering. When you look at these numbers, remember, these are not millions, these are billions of dollars in pure penalties. Barclays alone was hit with a jaw-dropping $2.4 billion fine. Citigroup was forced to pay over $1 billion. JPMorgan paid over $1 billion, and that is really just scratching the surface. UBS, the Royal Bank of Scotland, HSBC, basically a who's who of global finance, they all got hit incredibly hard. The global regulators finally woke up and realized that the internal compliance controls at these supposedly sophisticated mega institutions were essentially non-existent. These massive banks had basically handed the keys to the entire global financial kingdom to a few cocky guys in a chat room, and management just conveniently looked the other way as long as those massive profits kept rolling in every quarter.
When the dust finally settled, and all the investigations wrapped up across all the different countries, the total sum of the penalties was truly mind-blowing. Over $11 billion in total global regulatory fines were levied against the world's biggest financial institutions. Let that number sink in. $11 billion just in fines. And it wasn't just cash. The banks actually had to formally plead guilty to felony antitrust charges. Really think about what that means for a second. Major, supposedly reputable global banks, the places that hold your money, actually having to stand up in a federal court and officially plead guilty to felony market manipulation. It was an absolutely unprecedented moment in financial history. The wild, entirely unregulated era of the Wild West Forex market had been totally, brutally exposed for the whole world to see. But, and this is a massive but, this story actually has one final, completely fascinating twist. A twist that leaves you deeply wondering how justice really works in our modern world.
And this brings us to the ultimate mind-bending paradox of this whole explainer. On one side of the equation, you have the massive parent banks. They completely admitted their guilt, they paid out $11 billion in fines, and they formally acknowledged the felony manipulation on a corporate level. But then, on the exact opposite side of the equation, you have the actual individual traders, the specific human beings who physically sat at the keyboards, who actually typed out the messages in the cartel chat room, who literally joked about taking out the filth and sleeping with one eye open. Guys like Richard Usher, Rohan Ramchandani, and Chris Ashton. They were indicted and put on trial in a U.S. federal court. The prosecution showed the chat logs, they showed the trades, and yet, after a grueling 3-week trial, a jury completely acquitted them of all charges. In fact, it took the jury just 4 short hours of deliberation to find them totally not guilty. Wait, what? Think about that. The corporate banks were guilty, but the actual men who sent the incriminating messages walked completely free. How? Well, their defense team successfully argued that while the chat rooms obviously existed and the banter looked incredibly bad, their specific trading actions didn't technically violate the incredibly complex, narrowly written antitrust laws in the exact way the prosecution claimed. They argued it was just standard market color. They navigated the legal gray area and they completely beat the system.
Which ultimately leaves us with a profound and honestly, a slightly terrifying thought to end on. Yes, today, banks have supposedly cracked down. They have completely banned these types of private multi-bank chat rooms. They rely much more heavily on computer algorithms and automated trading now. And that crucial fixing window, it's been expanded from 1 single minute to 5 whole minutes to theoretically make it harder to jam up with a single burst of ammo. But at the absolute end of the day, in a market that is constantly moving over $5.3 trillion every single day, can we ever truly 100% remove the human element pushing the buttons? Because let's be real, whenever there is a financial system this unimaginably vast and a pool of money this incredibly immense, won't there always be someone, somewhere, quietly looking for the next blind spot? Thank you so much for joining me on this explainer. Keep your eyes open, keep questioning what's going on behind the screens, and I'll see you next time.